Greetings from Tamil Nadu Open University. I am Dr.R.TAMILMARAN, Associate Professor, School of Management Studies, Tamil Nadu Open University. Dear MCOM students, it is a second part video of Advanced Financial Management, which is MCOS 21. These courses has been in first year, second semester. In the second block of the course is sources of finance. This block consists of short-term and long-term finances. Purpose of finance. What are the innovative sources of financing to the firms or any organization? What are the factors determining the source of finance, either external sources or internal sources? What about this concept of working capital and its types and significance of working capital? Determinants of working capital. List out these various issues and methods of estimating working capital. Operating cycle method, especially the working capital calculations. You want to know about the working capital ratio so that the company can maintain its liquidity position. For now, initially, you have to know what are the sources of funds. So far, you have seen, you have known the what about this financial management, what is a finance, how we can manage it. In the second block, insist to identify the various sources of funds. The businesses aim to maximize their business gains, but they also need financial capital to operate the business. So, where does their money come from? Well, there are a variety of sources of finance. Take a closer look at some of the firms. Business finance is the funds required to establish, operate the business activities, and expand the business in the future. The funds are especially required various purchase type of tangible and intangible assets like furniture, patents, technical expertise, etc. Source of finance of business are retained earnings, equity, term loans, debt, letter of credit, debentures, etc. The working capital loans and venture capital also include the source of finance. In this part, without business, without funds, no business can live. Throughout the business life, money is required and it needs continuously. Firms raise money mainly to meet the following types of needs. Here it lists this money is helps to start a business as a initial investment or initial expenditure. The second one, to fund continuous business activities and money flowing. If you want to run the business, money is flowing continuous in the life of the business. Once the business is growing, the money is required to expand the existing business. So, expand its wings of the business, requirements of money is more essential. Here you are seeing the sources of finance or funds. The financial requirements may be for a long term, medium term, short term. Here, these requirements is classified or stated are three. One, short term funds, medium term funds, long term funds. For now, we are going to see what is the short term funds. It has listed bank credit, customer advances, trade credit. These are showing as S1, showing for example of short-term funds. The short-term funds that last more than 1 year but less than 5 years. The sources includes all borrowings from publics or commercial banks, commercial papers, loans from a financial institute, or very short-term lease financing. These are the short-term finance. The short-term finance, if you take any bank credit, we have to repay it within stipulated period. Sometimes if our brand, our product is very familiar among the customers, the company can claim the customers to pay in advance to market the commodities. That advance amount can be utilized for further business development and keeping the relationship with customers. The trade credit, which includes also the short-term funds. If the company procure the material from suppliers, as per the credit policy of the supplier, company can enjoy the trade credit. These the things is indicated the short-term funds. Next is medium term, issue of debentures, issue of preference shares, bank loan, public deposits, loans from financial institutions. The medium term funds in between the 5 to 10 years or more than 5 years. The company have to repay it or redeem it. The issue of debentures, which is a fixed rate of interest we have to pay the debenture holders. Whether the company is earning profit or not, the company is entitled to pay the interest rate to the debenture holders, by which the company can issue the debentures, can raise the funds. Issue of preference shares. The preference shares can be issued by which the company can provide fixed rate of dividend to the preference shareholders. The bank loan, company can raise the funds from bank in long-term basis to develop the business. The companies also claim the public to deposit their money like a bank as a fixed deposits. The interest rate may be more than bank what claims the bank, and other financial institution is ready to pay more loans to the companies which are very branded or reputed in the market. The third one is a long-term funds, issue of shares, issue of debentures, plowing back of profit, loan from other institutions. The issue of shares, which indicate the equity shares. Once if we issue the shares, permanently company can raise the funds, it can be utilized for the business development. The equity shareholders, those who having the shares, equity shares, he will be the shareholder. He will be a member of the company. That amount will be utilized for the business in permanent basis. On basis of the profit, the percentage of profit will be given to the equity shareholders as dividend. Issue of debentures is a long-term debentures company can rights to issue by which company can raise the funds. Playing fake of profit. Sometimes the company need not go for issue of any shares. If we have the accumulated funds, accumulated profits, that accumulated profits can be reinvested into the business. So the three ways to raise the funds for business. Here you are seeing many sources of finance on the basis of time, basis of ownership and control, basis of sources of generation. So the three bases, now we are going to see the first one, basis of time, long term, medium term, short term. The long term funds here list out equity shares, preference shares, internal accruals. What is the internal accruals? The internal accruals are nothing but the reserve of profits or retention of earnings that the firm has created over the years. Debentures, bond, term loans from the banks, venture funding. If you start any own business, if you have any ideas, if you have any project, based on the projects, many investors may come forward to invest on the project with the expectation of gaining more profit in future. Asset securitization and internal finance which include euro, international finance which include euro issue, foreign currency, loans, ADR and GDR, etc. The ADR is a deposit receipt issued by the US Depository Bank against a certain number of shares of non-US company stock. The GDR is a negotiable instrument issued by the International Depository Bank. So this is the way the Euro, ADR, GDR company can raise the funds in internationally. The medium term based on the time is more than 5 years. The company can raise the funds, preference shares, issue the preference, issue the debentures, medium term loans like financial institutes, government, commercial banks. Sometimes company will go for this lease finance, hire purchase finance. So these are the things company can raise the funds. Short term, on the best short term, within a year, company can maintain its funds through trade credit, short term loans like working capital loans, fixed deposit for period of 1 year, advances received from customers, creditors, payables, factoring services. Factoring services which include it is a financing technique in which there is an outright selling of trade debts by firm to a third party, that is a factor. Basis of ownership and control is owned capital, another one borrowed capital. The owned capital which include equity capital, preference capital, retained earnings, convertible debentures, venture fund or private equity. The borrowed fund means which include loans from financial institution, any commercial loans, any debentures. The basic sources of the generation, one internal, another one external. The same things happen. Is internally company can raise the funds through issue of shares, preference shares, retained earnings which include company can retain some amount from its profit, and convertible debentures. So the debenture can easily convert into the shares, venture funds. The external funds is retained profits. Sometimes the profits have to disposal to shareholders as a dividend. Reduction of working capital, sale of any assets is a external generation of sources. Here, we are going to see in elaborate manner regarding long-term finance and short-term finance. The long-term finance fulfills the financial requirements of your enterprises for a period extending 5 years. Here, it fulfills the requirements of an enterprises for a period not exceeding 1 year short-term finance. So, how this long-term finance is used? It is used for recurring fixed assets like equipment, plant, and machineries. If the company needs many equipments or plant, it has value of money is very high, by which the company can acquire long-term finance and acquire this asset by which company will make profits. It takes too much time to repay the finance. But if you go for whereas short-term finance, it is used to meet working capital, which is to meet the day-to-day operation. The example, how we can raise the funds through long-term sources. The shares, debentures, long-term borrowing, loans from financial institutions. Here, the short-term finance, the trade credit, loans from this bank, overdraft, commercial papers, trade credit. The next topic is what are the innovative sources. So far we have seen many sources of finance is a old type of rising funds. Then nowadays, along with the old type, nowadays is a very innovative sources to find your funds and procure it. The innovative sources and it is a mechanism of funding are non-traditional modes of finance. The finance is made available to business organization breaking the conventions. All the innovative sources are evolved in response to magnified and divergent need for finance. Here, what are the a few what type of this innovative source of finance? So it has listed out. It has been listed out one by one your own blood and sweat teas. That is called the sweet equity. So it is your choice to using your own unpaid labor and others' resource to get what you need. Barter and trade is one type of the business, one type of the rising funds. Your new business is by trading your skills for another without exchanging any money. The skills exit. The crowdfunding. It is a method by which you ask the public for finance assistance for your business idea. Invoice factoring is the process by which companies can get money for invoices that they have not been paid it. So company can rise through the micro loans, just as get one smaller loan from non-banking institutions. Government grants. If the government is permitted to do the business, or some government can welcome the new business people to come and start the business here for betterment of the employment. by which the government will give more grant to start up the new business. Here, the new sources or innovative sources can classify into two: one external financing, another one internal financing. The debt financing and equity financing special forms comes under the external financing. The self-financing, finance through depreciation or provisions, come under the internal financing. The debt financing, which include credit, loans, crowdfunding. We have already discussed about the crowdfunding. Crowdfunding is a way to raise money of an individual or organization by collecting donation through family members or friends of friends, strangers, or other business and more. By using social media, people can reach more potential donors than traditional forms of fundraising. Then is the equity financing, which include the business angels. The business angel or investor angels are people who invest their money in the initial phase of startups in exchange of all participation in capital. They also usually carry out the role of a mentor and offer their concerns and experience to entrepreneur. Venture capital is another one source of funds. So the new type of capital is required to bring out or exploit the new ideas or new projects. Mezzanine financing, which includes, it is a hybrid of debt and equity financing that gives a lender the right to convert the debt to an equity interest in the company in case of default. Generally, after venture capital companies and other senior lenders are paid, in terms of risk is exists between senior debt and equity. Next topic is factors affecting the choice of funds. Here, it has been listed out four factors. One is the cost of funds, use or purpose of funds, status and size of the funds, financial situation of your firm. The cost in terms of interest payments and other expenses, whether it may be long term or short term. The cost of funds will decide the company whether they procure or long term or short term funds. Use or purpose of funds. For example, a company is going to occupy a new plant. So the company need more capital. So how we can purchase the plant? Either company can go for lease finance or issue shares or bank. So the option will be selected by the company as per the cost of funds. Status and size of the business. For large firm, there are many sources of finance. The with they can procure the loan or procure the finance with lower interest, whereas the short-term firms will seek only a short-term finance. Financial situation of a firm. For example, a business in poor financial situation is forced to pay high rate of interest for the funds, debit funds, and the bank often requires security and collateral for their funds. The next topic is working capital, which is very essential in the business firm. Working capital is the difference between a company current assets and its current liability. It is a measure of a company's operational efficiency and short-term financial health. The working capital is simply says that current assets minus current liability. Current assets which include assets which is easily converted into cash within a stipulated period. The current liability means the debt is payable within stipulated period. That is stipulated period here only 1 year. But now you are seeing the current assets is a $1,60,000. The current liability is $65,000. What about the working capital is $95,000. So the working capital may be in either cash or short-term debt or inventory or advance payment or combination of both. The concept of the working capital. There are two concepts of the working capital. One is a balance sheet concept, another one operating cycle or circular flow concept. The working capital is a financial metric that is difference between a company current assets and current liability. As a financial metric, the working capital helps plan for future needs and ensure the company has enough cash and cash equivalents meet short-term obligations such as unpaid tax and short-term debt. Based on balance sheet concept, can classify into one gross working capital, another one net working capital. The gross working capital represents amount of funds invested in current assets. The net working capital is current assets minus current liability. The working capital can classify into two, one basis of concepts, another one basis of time. Basis of concepts, again it classified into two, one gross working capital, another one net working capital. The basis of time working capital can classify into two, one permanent or fixed working capital, another one temporary and or variable working capital. The permanent working capital which include regular working capital or reserve working capital, temporary and or variable working capital is a seasonal working capital. The difference between net working capital and gross working capital. Net working is a concept of qualitative nature. Gross working concept is a quantitative nature. So it has the many differences in the net working capital and the gross working capital. The net working capital is expressed as a current asset minus current liability, whereas the gross working capital indicating the total sum of current assets. The net working capital is very useful to find out true the financial position of the company, but whereas the gross working capital cannot reveal the true financial position of the company. So it has the listed 7 or more working capital between this net working capital and the gross working capital. But now here is a changes in net working capital. The net working capital is a fund. That fund is required to meet the short-term expenses in the organization. How we can find changes in the net working capital refers a difference between net working capital of any two periods in the years or quarter or month. How we can calculate this net working capital? We already see the current asset minus current liability is a working capital. Here in 2019 and 20, it is the current asset is of 15,000 and 20,000, current liability 8,000 and 10,000 respectively. Whatever the working capital, the working capital current asset minus current liability, which is 7,000 in 2019, 10,000 in 2020. So changes the working capital from 10,000 minus 7,000, 3,000 is changes in working capital according to the balance sheet model. What about this importance of working capital? Is a relevant part of cash flow statement. It is an essential input for the company valuation. It throws a light on liquidity position of company. We can find this. What about this liquidity position? Whether we have to strengthen or we have to go for the sound position in the company. Also provide information on business growth. Working capital cycle. The working capital cycle which we include. The working capital refers to a time taken by organization convert a net working assets, current assets and current liabilities into cash. It's a short-term period we can take into account. Is a line is a many sources of the working capital's line of credit, factoring, trade credit, and short-term credit. The working capital determinants. Here we have listed out these determinants of working nature of industry, nature of business, business cycle, cash requirements, volume of sales, inventory turnover, business turnover, current asset requirements, production cycle, manufacturing time, terms of purchase and sales, operating efficiency, attitude towards risk, cash reserves, finance policy, dividend policy, manufacturing policy, credit control policy, operation efficiency, change in technology, inflation or price level changes, profit planning and control, repayment ability, price level changes. These are affects or determine the working capital of an business concern. Here we have already seen this working capital, the both side. What about this significance of working capital management? It is in a typical manufacturing firm. Current assets are almost half of the total assets, and for trading firms it can be even more than half of their total assets. The excess levels can result in substandard return on investments, which includes net profit divided by total assets. So, where the total assets include current assets and fixed assets. Based on these total assets, it can be calculated the net profit. The methods of estimating working capital requirements. Main method, we have already seen is the operating cycle method, projected balance sheet method. The working capital requirements is equal to cost of goods sold into operating cycle. Usually is a 365 days or 360 days plus desired cash balance. How we can find out this working capital ratio? The working capital ratio is current asset minus current liability. For example, is a current assets which include cash and cash equivalent, marketable securities, net receivables, inventories, prepaid expenses. These are example of the current assets. Current liability is accounts payable, short-term finance, other short-term liabilities. So the current assets which is easily converted into cash within a short span of time. The liabilities which is payable to the outsiders within short span of time. So here the company A and B were there the current assets and current liabilities source. The last one is a sample of balance sheet of working capital ratio. The asset here is listed out cash, account receivable, inventory, and equipments, buildings, and total assets, which includes is equipments, buildings, total fixed assets, cash, and accounts receivable, inventory is current assets. In the liability side, accounts payable, line of credit is a total current liability. Long-term debt is a total liability, and equity is also total liability and equity. Here we are going to take this current asset is a $6 lakhs, the current liability $3,50,000. So the current working capital ratio is 1.71:1. So in the standard of the working capital ratio is a 2:1. The 2 may be the 2 is shall be current assets and the 1 is a current liability, which is a standard ratio. Thank you. You have known the sources of finance. Thank you.